Okay, let's dive in. You know that saying, history doesn't repeat, but it often rhymes?
hmm I do.
Well, looking at 2025, the talk around oil prices, it's starting to sound pretty familiar, like those old peaks we thought we'd left behind.
Right, that $150 a barrel number is suddenly back in the conversation, isn't it?
It really is.
Uh,
So today we're digging into this piece by Tony Hicks, just out this month, June 22nd, titled Brace for $150 barrel oil, What It Means and What Comes Next.
a timely piece.
Absolutely. And our mission really is to get under the hood. Figure out what's actually driving this, who stands to win, who might lose out, and why this whole $150 oil scenario might be more than just a temporary blip. Why it could be a major signal for you and for the world.
And what's really striking is just how many different threads are pulling in this direction. It's not just one thing. We need to unpack why this potential new normal, well, why it's not really normal at all.
Good point.
Mm.
Because for a good chunk of the last 10 years, oil prices were, well, relatively calm, weren't they?
Yeah, quite subdued mostly.
You had the whole U.S. fracking revolution. OPEC plus constantly arguing amongst themselves. Demand was kind of moderate. But the source we're looking at says things are very different now. So what is driving this shift? The article calls it a perfect cocktail for a price shock. What's actually in that cocktail?
Well, it's quite a potent mix, several ingredients. First, Russia's war in Ukraine is still a major factor, obviously destabilizing energy flows.
Still ongoing, yeah.
Then you've got the Houthi attacks in the Red Sea. They're actively messing with supply chains, making tankers take longer, riskier routes.
Big disruption there.
Huge. And geopolitically, you've got Iran and Saudi Arabia playing this sort of passive-aggressive production game, holding back supply sometimes.
Chess match, as
That's
the
it.
article puts it.
Exactly. Meanwhile, U.S. shale, which was the big growth engine, well, it's maturing. Production growth has really slowed down.
Not the gusher it used to be.
Not at all. And then maybe the most ironic part is that investments in green energy, while happening, are currently under-delivering on the scale needed to really displace fossil fuels quickly.
So all these things hitting at once.
Pretty much. It creates this massive squeeze. And it's not just speculation. The IEA, the International Energy Agency, they've warned markets are tightening significantly. Even Goldman Sachs is talking about $150 scenarios.
Wow. Okay, so multiple forces converging. It really underscores how complex this is. And the article drives home oil's role as the, quote, bloodstream of globalization.
Mm-hmm.
Ships, planes, trucks, plastics, fertilizers.
Right.
It's in everything.
Absolutely fundamental.
So we do see that 50% plus jump to $150.
Mm-hmm.
What does that actually feel like for you and me in our daily lives?
Well, the article puts it starkly, inflation is strapping on combat boots.
Oof. Okay.
Yeah. When oil hits $150, transport costs just explode. So shipping costs up, food prices up because of fuel and fertilizer. Logistics in general, slower and way more expensive.
Everything costs more to move.
Everything. The article even quips that even Amazon Prime starts to look like a luxury service because delivery costs get so high.
Huh. I can see that.
So the point is, it's not just pain at the pump, though that's bad enough. It's this deep inflation that works its way into almost everything you buy. Hits your wallet from all sides.
Okay, so consumers definitely feel the squeeze, but, high prices usually mean someone somewhere is doing very well. Who are the winners if oil hits $150? Who's popping the champagne?
Oh, absolutely. There are clear winners. Top of the list, big oil. Companies like Exxon, Chevron, BP, Saudi Aramco. Their executives, their shareholders.
Right.
Their cost to get oil out of the ground, their break-even, is often really low, sometimes under $40 a barrel.
Under 40, seriously.
Yeah. So at $150, they are basically, as the article says, printing money. Just
Wow.
massive profit.
Incredible margins.
Then you've got the oilfield services companies, Schlumberger, Halliburton, Baker Hughes. When prices are high, drilling activity picks up, so they get busy.
Makes sense. More drilling, more services needed.
Exactly. And even places like the Canadian tar sands, which usually have higher costs, suddenly become, quote, economically sexy. Companies like Suncor, Canadian Natural Resources, they do very well.
So higher cost producers become viable again.
Very viable. And then there's the geopolitical angle. Certain governments really benefit. Venezuela might actually, pay its bills.
A lifeline for some regimes.
Definitely. Russia gets a huge boost for its war chest, helping fund its conflicts. Iran gets more room to play rogue on the world stage. The source is blunt. When oil's expensive, dictators get cocky.
That's a chilling thought. It's not just about money changing hands, it's about global power shifting.
Precisely. It can really embolden certain states.
So, okay, we've got the winners. The oil giants, the service companies, certain regimes. What about the flip side? If they're clinking glasses, who's getting crushed by $150 oil? Who's on the losers list?
Well, as we touched on, consumers are definitely number one. It's not just gas prices, though those obviously soar. It's groceries, airline tickets, clothes, even your electricity bill. Expect consumer sentiment plummeting, as the article says.
And that shrinkflation thing comes back too, right? Smaller packages, same price?
Oh yeah, expect shrinkflation in full force. Then, airlines are major losers. Fuel is like 20–30% of their costs.
That's a huge percentage.
Massive. So for them, it becomes a game of survival. The source specifically mentions budget carriers like Spirit and Frontier could be in real trouble. Their margins are already thin.
Yeah, they operate on tight budgets.
Exactly. And then think about emerging markets. Countries that have to import most of their oil, India, Turkey, lots of nations in Africa, they get slammed.
How so? What happens there?
They face crippling import bills, their currencies can get hammered, and they often experience really sharp inflation. It can easily trigger debt crises. It's a huge source of instability.
So a potential global ripple effect, especially hitting developing nations hard.
Absolutely. And ironically, the green energy transition itself can suffer. You'd think high oil prices would boost renewables, and in some ways they do.
Makes them look cheaper by comparison.
Right, more competitive economically. But it also tends to re-legitimize big oil in the short term, and crucially, it makes governments really nervous about pushing green policies too hard if people are already screaming about high energy costs.
The political angle.
Yeah. The article says, when gas hits $6, voters don't want windmills. They want lower prices now. It forces a focus on immediate relief.
That's a really powerful point about voter priorities.
Yeah.
Does the article suggest any way around that, or is it just immediate pain trumps long-term goals in a crisis?
The piece leans heavily towards immediate pain dominating the political landscape. It paints a picture where that desire for relief now often pushes aside those longer-term environmental concerns, at least for a while. It really highlights the vulnerability, especially for those import-dependent economies.
Okay, so given that scale of pain and potential instability, what about the big financial players, the central banks, like the Fed here in the U.S.? How do they react if oil goes to $150 and inflation spikes again?
That's a huge question. If oil pushes overall inflation back up past, say, 4 or 5%, forget about those rate cuts everyone's been hoping for.
Right, cuts are off the table.
Completely. The Fed likely turns hawkish again, maybe even raises rates more aggressively to fight inflation, and that gives the financial markets a nasty hangover.
Meaning?
Stocks likely get slammed, bonds take a hit, the real estate market could freeze up again. It brings back the Fed's biggest nightmare, stagflation.
Slow growth and high inflation. The worst of both worlds.
Exactly. And this whole scenario also creates a real headache for ESG investing, environmental, social, governance funds.
How so? What's the dilemma?
It's a moral and financial pretzel, as the source puts it. Do these funds stick to their no fossil fuels pledge, even if it means their performance tanks compared to the market? Or do they kind of bend the rules and add energy stocks back in to protect returns?
That's a tough spot. What are they actually doing?
Well, the article notes that big players like BlackRock and Vanguard are already quietly increasing energy exposure, even while talking about climate goals. It suggests the energy transition isn't just underfunded, it's underperforming when push comes to shove in the real world.
So, $150 oil forces a reality check for monetary policy and sustainable investing.
Interesting. Now, thinking about supply. People might remember the U.S. shale boom sort of saving the day in the past, right? Flooding a market, keeping prices down. Can we expect that again?
Not really, no. The source is pretty clear that the dynamics have shifted quite a bit.
Why not? What's different this time?
Several things. First, those shale wells deplete much faster than traditional wells, so you need constant drilling just to stand still, let alone grow production.
Okay, high decline rates.
Right. Second, investors aren't just throwing money at drillers demanding growth at all costs anymore. Now they want profits, dividends, buybacks, discipline.
So less incentive for breakneck drilling. Less incentive, yeah. Plus, drillers face more regulatory hurdles now, ongoing worker shortages, and definitely more environmental pushback, making it harder to get permits. So even if prices spike, you won't see that same explosive growth from U.S. shale. Supply is likely to remain tight, almost by design, as the article says.
And what about the Strategic Petroleum Reserve, the SPR? Can that help cushion the blow?
That's another problem. The article calls the SPR an Empty holster.
Empty holster. Why?
Because it's been drawn down significantly in recent years to try and manage previous price shocks. It's much lower than it was, and refilling it now when oil prices are potentially much higher, that's politically really difficult and very expensive.
So the backup tank is low and refilling it is tough.
Pretty much. So key supply cushions aren't there like they used to be, and the previous savior, U.S. shale, isn't riding to the rescue this time. The market's just more vulnerable.
It really feels like $150 oil creates this strange paradox for the whole green energy movement, doesn't it? It helps it, but it also hurts it.
It absolutely does. It's a real double-edged sword.
How does that play out?
Well, on the one hand, super expensive oil definitely makes solar, wind, EVs look much better economically.
Right.
The cost comparison gets way more favorable.
Sure, makes sense.
And it can push governments and regular people to think harder about energy security, maybe accelerate some green investments out of necessity.
Okay, so that's the help side. What's the hurt side?
The hurt side is that in the immediate term, it can spark new wave of investment back into fossil fuel infrastructure just to get more supply online quickly. And maybe more damagingly, it makes voters really angry about energy costs now, making them hostile to policies, seen as adding costs or disrupting supply, even if they're good long-term climate policies.
Back to that voters want lower prices now idea.
Exactly. The article sums it up well. If green alternatives were ready for prime time, we wouldn't be staring down $150 oil. But they're not. So when prices spike, there's often this panicked rush back to what seems reliable, which is usually fossil fuels, potentially setting back climate goals.
So the transition gets caught in this bind. High oil makes it appealing, but the pain causes a retreat.
That's the paradox, yeah.
Okay, let's switch gears a bit. This deep dive is about understanding, but also preparing. So let's get practical. How can someone listening, navigate this? How do you play $150 oil like a, quote, capitalist with a conscience, or at least a calendar?
Right, the practical side. The source lays out a few strategies. First, maybe obvious, is considering investments in energy stocks.
Like the big oil company.
Yeah, or broad energy ETFs like XLE. Think ExxonMobil, XOM, Chevron, CVX, maybe Canadian producers like Canadian Natural Resources, CNQ, or even some U.S. players like Devon Energy, DVN. The logic is high prices mean huge cash flows, dividends, buybacks.
Okay, so lean into energy producers. What else?
Conversely, probably avoid industries that get hammered by high energy costs.
Oh.
Airlines, cruise lines, some logistics companies with really thin margins, their costs explode.
So you're clear of the energy guzzlers. Makes sense.
Third, think about commodities and inflation hedges. Things like gold physical or ETFs like GLD silver, maybe broad commodity ETFs like DBC, or even agriculture plays like DBA, things that tend to hold value when inflation rises.
So hard assets, inflation protection.
Exactly. And related to that, maybe hedge with other real assets. The source mentions things like oil-rich REITs, real estate trusts focused on energy properties, or farmland funds like land, or even pipelines and MLPs, master limited partnerships like EPD or MPLX, which transport the energy.
Interesting. So diversify into assets that either benefit from or are somewhat insulated from the energy price shock.
That's the core idea, yeah. Pivot towards things that can weather or even thrive in that kind of inflationary high energy cost environment.
Okay, practical steps noted. Now back to the politics. You mentioned voters getting angry. If $4 gas caused political headaches, what happens politically if we actually see $6 or $7 gas?
Yeah, the political fallout could be intense. As the article suggests, $4 gas made people mad. Wait until it's $7.
So what does that mean in practice?
History strongly suggests incumbents, the politicians currently in power, are in big trouble. High gas prices are just politically toxic.
People vote with their wallets.
Very much so. You'll see politicians scrambling. They might float ideas like price caps, though those rarely work and often cause shortages. You'll definitely see energy subsidies thrown around like candy, trying to ease the pain.
Short-term fixes.
Exactly. And the big casualty is often long-term policy, especially climate policy. It gets sacrificed at the altar of short-term relief.
Because the immediate pressure is just too high.
Precisely. The article reminds us of presidents like Jimmy Carter, George H.W. Bush, who struggled mightily with energy crises. And you can see how that same dynamic could absolutely impact someone like Joe Biden today. The political pressure becomes immense.
So bring it all together. We've talked about the drivers, the winners, the losers, the economic fallout, the supply issues, the political heat. The big question hanging over all this, could we actually hit $150 a barrel? Is that a real possibility, according to the source?
Yes. The source treats it as a very real possibility, not just some wild outlier scenario.
What makes them so convinced?
It's the combination of factors we've discussed. You've got OPEC plus generally holding back supply, keeping things tight. You've got constant geopolitical risk with the flare-up between Iran and Israel, another major Houthi attack, maybe a surprise Saudi production cut. Any one of those could theoretically push prices up sharply.
So the market's fragile.
Very fragile. Demand has also been surprisingly stubborn. It hasn't fallen off a cliff despite higher prices. So you have this tight supply, volatile politics, and sticky demand. It wouldn't take much to tip it over $150.
And if it does hit $150, is that the peak? Does it stay there? What's the longer-term view?
Well, $150 might be a spike. It might not last forever at that exact level. But the underlying message from the source is that the structural conditions are now in place for potentially a multi-year bull market in energy.
Meaning higher prices for longer.
Yes. Primarily because there's been about a decade of serious underinvestment in finding and developing new oil sources globally. The world basically took a long break from investing heavily in oil, partly due to climate pressures and previous low prices. Now we're playing catch-up with bad timing.
So the supply side will struggle to respond quickly, even if prices are high.
Exactly. It takes years to bring major new oil projects online. So the advice is, basically, expect volatility, expect pain. But most of all, expect higher prices to become the new baseline, not the outlier.
So we're maybe entering a new era where energy is just fundamentally more expensive, more volatile.
That seems to be the core takeaway. An era defined more by energy scarcity, or at least tightness, driven by both geopolitics and those past investment decisions.
Wow. Okay, so wrapping up. It sounds like $150 oil is far more than just a number.
Oh, absolutely. What's really fascinating here, as the article implies, is that $150 oil isn't just about your gas bill or Exxon's profits. It's actually a really powerful signal.
A signal about what?
About the, maybe, fragility of our current model of globalization. About the real-world limits and timelines of the clean energy rollout. About the significant political costs that come with mismanaging that energy transition. It might even signal a subtle rebalancing of power, maybe back towards energy producers, east versus west. It's a fundamental shift indicator.
So as the article concludes, it's a signal flare. Don't just brace for $150 oil. Plan for it. Maybe even profit from it. Definitely prepare for what it means. Because in 2025, oil isn't just fuel, it's destiny. Hopefully this deep dive has given you a bit of a shortcut to understanding this really critical issue, something that's definitely going to shape the months and years ahead, and maybe given you some things to think about for navigating it all.